Is the Kioxia Holdings Corp derivative token a revolutionary bridge between traditional equity markets and decentralized finance? Or are investors completely blind to a massive structural collapse? Right now, the Kioxia asset is trading at approximately $529.18, flashing a significant and rapid 7.9% gain over the last 24 hours. But don't let this sudden daily surge fool you into thinking the trend has permanently reversed. If you zoom out to the multi-week charts, the overarching trend is highly concerning, characterized by consistent lower highs, deteriorating support levels, and technical sell signals that are flashing major warnings across institutional tracking dashboards. Despite this broader downward pressure, a passionate group of synthetic asset investors and value-driven traders are aggressively arguing that this token is massively undervalued at its current price. They claim the market is severely mispricing the massive global demand for enterprise flash memory and data storage infrastructure. Are these buyers forward-thinking visionaries locking in a historic bottom, or are they walking directly into a beautifully disguised value trap? Let's break down the mechanics and the data to find out exactly what is happening under the hood. To truly understand why the Kioxia Holdings Derivative Token is dominating institutional trading discussions and on-chain volume today, you have to understand what this unique asset actually represents. Unlike standard meme coins or speculative utility tokens, Kioxia operates as a tokenized financial derivative. This means it is designed to track the value and performance of Kioxia Holdings Corporation, the world-renowned Japanese computer memory manufacturer formerly known as Toshiba Memory. The project brings traditional corporate equity exposure directly to the blockchain, allowing global investors to gain price exposure to high-tech manufacturing infrastructure without traditional banking gatekeepers. It is in sharp focus right now because the semiconductor and NAND flash memory markets are experiencing massive cyclical volatility driven by supply chain shifts, enterprise data center upgrades, and intense global competition. When real-world market dynamics shift, speculative capital pours into these tokenized derivatives, causing sharp liquidity swings. However, the core challenge facing this asset right now is the complex maintenance of the liquidity peg and the systemic risks associated with synthetic market makers. Before we fully dissect the technical chart patterns and structural vulnerabilities, do me a massive favor. Smash that like button, subscribe to the channel right now, and leave a mandatory comment below sharing your current playbook. Are you accumulation buying this derivative, cutting your losses, or waiting on the sidelines? Drop your thoughts right now because your comments keep this channel alive and push us out to the global algorithm. Let's pull up the charts and jump right into the technical analysis. Because while sentiment can be manipulated, order books and historical price action never lie. When you analyze the daily and weekly timeframes, the Kioxia token has been trapped inside a clear, well-defined descending channel. Every single attempts by the bulls to stage a sustainable breakout have been met with aggressive institutional distribution at the 50-day moving average, which is acting as a heavy dynamic ceiling. This recent 7.9% daily push has driven the price straight into a major horizontal resistance zone right around $530. If the current buying volume stalls out at this level, this move will be categorized as nothing more than a standard dead cat bounce. Looking at the momentum oscillators, the Relative Strength Index, or RSI, has quickly bounced out of near oversold conditions and is currently sitting in the mid-40s. This shows a temporary injection of short-term buying strength, but the overall volume profile remains incredibly thin. The critical support floor is currently resting at the $500 psychological level. If that major boundary snaps on a high-volume daily close, there is a total lack of historical order block support beneath it, which could trigger an accelerated downward spiral as automated liquidation protocols kick in. Short-term strength looks highly superficial, while macro-structural weakness remains firmly in control. When we pivot our attention to the analyst ratings and smart money flow signals, the broader outlook requires extreme caution. On-chain derivative dashboards and synthetic market metrics are currently maintaining a strong sell or heavy hold rating on the Kioxia token. The negative indicators are accumulating quickly behind the scenes, particularly regarding systemic funding rates and whale liquidity movement. Over the past 30 days, blockchain analytics revealed that several large-scale liquidity providers and early-stage backers have been systematically reducing their exposure, taking advantage of short-term price spikes to exit their pools and pass the asset risk to retail buyers. When the primary market makers of a synthetic asset begin trimming their positions, it creates an incredibly heavy overhead supply wall that makes a sustained market recovery highly unlikely. Furthermore, institutional sentiment indicators highlight that the token's volume is concentrated across a very small number of decentralized derivative platforms, which inherently amplifies the risk of sudden, erratic price manipulation. The short-term outlook suggests that unless there is a massive fundamental upgrade to the protocol's backing mechanisms, the path of least resistance for the Kioxia price remains heavily tilted to the downside. This reality brings us to the ultimate, highly polarized debate. Is the Kioxia Holdings derivative deeply undervalued, or is it a dangerous value trap waiting to crush retail portfolios? The bullish argument is built on the fact that at $529, the asset is trading at a significant discount relative to the corporate giant's global industrial footprint. They believe that as real-world asset tokenization scales and traditional finance continues to merge with Web3 infrastructure, tokenized enterprise derivatives will capture massive market share, making this a prime accumulation zone. The bear camp, however, views this perspective as a highly dangerous misunderstanding of synthetic asset risks. A value trap occurs when an asset looks highly attractive simply because its nominal price has fallen, while its underlying structural mechanics are actively deteriorating. If a tokenized derivative cannot maintain deep, continuous liquidity pools and tight tracking efficiency against the underlying physical equity, the asset becomes a systemic hazard. A low relative price doesn't automatically mean you are buying a bargain. It can simply mean you are holding an asset on a slow, painful march toward complete illiquidity. The downside risks embedded in high-value tokenized derivatives like Kioxia are absolutely massive, and retail traders constantly get trapped in these exact market setups. The main reason retail investors suffer devastating losses here is a fundamental misunderstanding of synthetic market structure. Traders look at the high dollar value and think, this is a blue-chip enterprise asset, so it is inherently safe from total collapse. What they completely fail to realize is that on-chain derivatives carry unique layers of platform risk, smart contract vulnerabilities, and liquidity constraints. Because these high-priced tokens often have highly illiquid order books compared to traditional stock markets, they are subject to extreme, sudden volatility. When a broader market panic hits, liquidity can evaporate from the pools in a matter of seconds. This creates a worst-case scenario known as catastrophic slippage, where the displayed market price might say $500, but when you actually try to execute a market sell order, the lack of depth forces your transaction to execute at a much lower, devastatingly unoptimized price. Let's clearly outline the absolute best case recovery scenario versus the worst case bear continuation. In the absolute best case bull scenario, the derivative platform rolls out an institutional grade security upgrade, integrates fully with a Tier 1 compliance network, and introduces an automated yield generating arbitrage mechanism. This fundamental breakthrough would force short sellers to rapidly cover their positions, triggering an explosive short squeeze that could violently drive the price back up toward major psychological resistance levels at $600 and $650. On the flip side, the worst-case continuation scenario is supported by significantly more historical chart data. If the immediate support floor at $500 fails to hold during the next broader cryptocurrency market correction, automated stop losses will trigger a cascade of market orders. This panic selling could easily result in a brutal 40% to 50% liquidation event within a single trading day, leaving late-stage retail buyers holding a highly illiquid asset. Looking at the comprehensive outlook, we are watching two completely separate timelines unfold simultaneously. In the immediate short-term perspective, the overarching macro trend is undeniably pointing straight down, and fighting that trend is historically a losing battle. Expect continued choppy price action, deceptive fake-out pumps, and high-frequency volatility as the market aggressively tests the psychological threshold of current token holders. From a long-term perspective, the survival of the Kioxia token relies entirely on the platform's ability to transition from a speculative trading vehicle into an indispensable, seamlessly integrated financial tool for global asset allocation. Without a structural overhaul in how the asset peg is defended and an expansion of cross-chain liquidity access, the long-term chart will inevitably continue to mirror the short-term macro decline. So, where does that leave us at the end of the day? Is the Kioxia Holdings Corp derivative token a ticking time bomb waiting to completely wipe out the remaining retail community? Or is this current range the definitive historic bottom before a massive multi-$100 reversal that catches the entire market completely off guard? The data is sitting at a brutal, unforgiving crossroads, and the next major breakout or breakdown is going to catch thousands of undisciplined traders completely unprepared. Which side of the order book will you be standing on when the real move begins?